So, hello and good afternoon. I welcome you to today's weekly market outlook here for Admiral Markets. My name is Jens Klatt, and yeah, we'll have the pleasure to be together for the upcoming 45 minutes around. Today, it's not only a weekly market outlook. But also I'd like to make it some kind of NFP special. So it's the first Friday of the month, which means that today NFPs will be published, usually a high volatility event over the last months. It hasn't been such a high volatile event as it was several years ago. Due to the fact that the overall monetary policy path from the Fed was already leveled and given, but this changed a little, and it's not that it dramatically changed, but on Wednesday with the Fed decision, Jay Powell made things clear, to put it that way, and that is now something of high interest because market were probably a little too dovish for the Fed, a little too bearish for the US dollar, priced in a rate cut with nearly 60-65% by the end of this year. And this is currently changing, but still there's some dovishness priced into the market if we look at something like the Fed Watch tool, for example. And that said, could mean that an NFP reading which comes in significant above expectations could trigger some significant US dollar bullishness, and that said, you push EURUSD towards 111, for example, or gold significantly lower, below 1,266, below the April lows. And this is of high interest, sure, and then this is something we want to dig deeper into. But before we start, as usual, the risk disclaimer. Trading with financial instruments offered by Admiral Markets carry a high level of risk, which is not suitable for all investors due to their complex nature. And before entering into a client agreement or making a transaction, please make sure that you read the terms and conditions of the service from Admiral Markets. This were only the first three sentences of the risk disclaimer. The whole disclaimer can be found on the website from admiralmarkets.com. Please feel free to go there. Nevertheless, as usual, we want to dig deeper into something new in terms of regulation, the so-called ESMA decision and the differentiation now taking place between retail clients and professional clients. And here, what's noteworthy is that now there's a leverage restriction for retail clients with a max of 1 to 30 in Forex majors, for example, like EURUSD or Pound USD, Dollar JPY, but also a leverage restriction when it comes to so-called minor currency pairs. This is GBP, Australian dollar, for example, but also CFDs on indices like the DAX30 or also gold. And this leverage restriction can be of interest, and some people, due to their traded strategies, probably have to adapt. And there is a chance to adapt. Nevertheless, you have to meet certain criteria to adapt. There's this differentiation, as I already said, between retail clients and professional clients. Professional clients, if you meet two of three criteria, further info is on the website also from Admiral Markets, you can apply for be categorized as a professional client, but it has to come from your end, by the way. So it's not that Admiral contacts you, but you have to apply for this, and then you have to make sure that you meet the criteria. And then there is no such leverage restriction. Interestingly enough, it's also that after the ESMA decision, there is now a negative balance protection, which is unlimited for retail clients, while professional clients do not necessarily have such a negative balance protection at a broker. But in case of Admiral Markets, they have a special offer here. According to their policy, you are safe in regards to negative balances up to £50,000 sterling. Also, please feel free for further information to reach out to your Admiral Markets service support desk. This is the face to the voice you're currently listening to. So as I already said, my name is Jens Klatt, and I'm located in Berlin, Germany. So probably this is of the highest interest for some of you. In the next slide, you will see that Admiral Markets is a global broker, or it has a global offering also. is located in several countries around the globe. And the Berlin, respectively Germany, there is one office from Admiral Markets. And here in Germany, we usually refer to Admiral Markets as the so-called DAX expert. And this is among traders in general the case. And the reason for that is that Admiral Markets has a highly competitive offering when it comes to DAX trading, with a typical spread of 0.8 points during the main trading hours. What's probably even more interesting, especially for short-term traders, scalp traders, is, or traders scalping the DAX, that there is with the offering Admiral Prime a chance to get a typical spread of 0.2 and then pay a commission on top of that. Also here, reach out to the website. Feel free to get in contact with Admiral Markets directly. I think this is a very, very good offering and something noteworthy when it comes to short-term scalping traders. By the way, the same is also true for FX markets, surely. So Admiral Prime, Admiral Markets, sure, also offers very, very attractive spreads, very attractive trading conditions. So feel free to check out the conditions on the website. One World Global Offers, this is what I already mentioned. So there were several offices around the globe, for example, in Germany, but also one in Chile, for example, or also one in Australia. It's Admiral Markets Pty Limited then. So what this could mean in terms of your trading, if you're located there, also from a regulatory standpoint, reach out to Admiral and to the website, find out on all the infos around this there. Here are the contact details. And so then let's switch over to our agenda for today, even though at the beginning I already mentioned it, but nevertheless, let's go through it again. So we want to answer the questions: what are the key economic events in the coming trading week? Not only the upcoming trading week, but also today with the non-farm payrolls. Then, sure, what's the current bias in the FX, equity, and commodity markets? Also here, I already mentioned, markets seem to be a little too short US dollar right now, which trading opportunities may arise out of this. And these are the questions we want to answer here. And that said, switch over here to the chart. Let's have a look at the euro. And so we can already see here, the euro is already taking on momentum on the downside, currently eyeing, let's say, the lows we marked last week on Friday. So, but let's first start with the weekly market outlook last week, probably. Some of you might have listened to what I had to say, and I have to say I was really, really, really surprised about the price action taking place not only last week on Friday, but also then over the first 3 days this week, so Monday, Tuesday, and then Wednesday. And what do I mean by that? Well, last week we talked about a data set which came out, GDP data from the US. And the short version of what I said was, if numbers come in better than expected, you should usually expect the US dollar to outperform, especially against the euro, and it wouldn't come as a surprise if we closed the week below 111. So what happened was the numbers came out better than expected, 3.2%. And we saw a short spike on the downside, bringing us down to the current yearly lows at around 11.10. And then from there, euro US dollar traded higher. And not only on Friday itself, which was, by the way, not a big deal, because then you could probably argue why this short bullish US dollar bullishness was sold off again. You could argue that numbers around the GDP growth were probably a little manipulated by government spending, for example, or you could argue, well, inflation data coming in that same day, well, came in below expectations, so you have economic growth, still no inflation, which could bring the Fed then here to say, okay, well, we probably have to cut rates rather sooner or later into the end of the year. So all this was possible, but what was very difficult to explain was where this sharp reaction, let's call it, was coming from, because low volatility is still given in the currency markets. And after we pushed down to 111.10, euro US dollar pushed as high as 112.60, so 150 pips from the lows up to the highs in a low volatility market environment, in an environment in which you usually do not want to be long the euro against the US dollar, especially given the current huge divergence in the yield differential between euro and US bonds here. And while I have really no explanation why this took place, even though, well, probably we could argue now, say markets were expecting a rate cut by the end of the year, it still doesn't, in my opinion, not explain this huge move. Jay Powell, the Fed chairman, got things right last Wednesday, and he clearly stated, he emphasized that here there is, for the Fed currently, the Fed is currently not seeing a case for a move in either direction when it comes to rates, which means they're not seeing a rate hike, but they are also not seeing a rate cut. And you probably have seen the strong reaction in the US dollar then on Wednesday, when the US dollar took on serious momentum and the EURUSD closed that day here below 112. And so, well, if you just wonder what happened here in the background, that was my cat, obviously being a little hungry, but she's not dying. Don't worry. Okay. So, well, and we closed the day below 112. Then we also had gold, for example, see a huge push on the downside. In this regard, it's also worth mentioning again this head shoulder formation here, the retest of the neckline, and then we took on momentum, pushed as low as 1,266 yesterday, and probably with a better than expected reading for non-farm payrolls today, a break will occur, and then we take on momentum, which will potentially bring us as low as 1,230 USD, probably even lower in the days to come. So in regards to the euro US dollar, let's come back here then to the current outlook for the non-farm payrolls. And therefore, let's switch over here first of all to a tweet from Donald Trump that was on Tuesday, and it's in my opinion, personal opinion, it's crazy what had just happened there. So Donald Trump, as you can see here, just 1 second, please. I'll be back in a second. So here I am again. So that was a tweet, and this really it's crazy, let's say, because he's talking here in this case of the U.S. economy, which could go up like a rocket if we did some lowering of rates like 1 point. So lowering interest rates by 1% from the current level at 2.25, 2.5. Bringing it down 1% from here, and also some quantitative easing. So he's really bringing up quantitative easing, lowering interest rates, quantitative easing in an environment where here, for example, GDP is at 3.2%. The employment or unemployment rate is at record historic lows, while equity markets are trading near their all-time highs, bringing up such aggressive easing policies here, which, by the way, wasn't taken seriously from markets, but nevertheless, you could still feel that the US dollar, or especially market participants, were really skeptical if the Fed can really, based on such a statement from the US president 1 day before the rate decision, if the Fed can really come out hawkish, respectively neutral. So there was a clear dovish stance, and this is something you can clearly also spot. And then let's close this here. Let's have a look here at the Fed Watch tool. You could see this when looking, for example, 1 week ago at this expectation from market participants in regards to rates at the end of the year. So what does this show us? It's the so-called Fed Watch tool. You can just Google it, and then it will pop out right at the top. And it's the expectancy from market participants here at the CME in this case, what rates they see, or where they see the Fed's funds rates here. In this case, in December this year, December 2019. And so here, this is the current level. So this is not clear blue, but this structure above it. And now here at the bottom, you have a probability, and they show you what was the probability, for example, yesterday. So did it change? Or also, what was the expectation 1 week ago? And here on the 26th of April, you can see that there was an expectation of 35% of the among market participants that the interest rates will be here between 2.25 to 2.5% there. So it means 65% or 2/3 of market participants saw the Fed lowering rates at least once, so by 25 basis points by the end of the year. And this given some strong data. I mean, well, in this regard, we are mainly talking about an environment where only the inversion of the yield curve to 10-year, in this case, of US yields, 10-year, 2 and 10-year yields, is pointing to a recession. And I'm very certain that this will happen rather sooner than later. Nevertheless, it still takes time. And now bringing up easing or interest rate cuts leaves you vulnerable to have no ammunition ready once the economy really once the economy dives into a recession. So, and with this expectation, we came into the Fed rate decision then on Wednesday, and there Powell again got things clear, and he said that it's not only that the Fed is non-political and doesn't take President Trump's comments into account when it comes to taking action, but also again that he, or respectively the Fed itself, does not see any case for moving the monetary policy in either direction. So, and with this in mind, markets then started to find out, okay, we're on the wrong side here. We are too bearish for the US dollar. We are too dovish in regards to the monetary policy and the outlook of the monetary policy for the Fed. And we have to buy back here the US dollar, which we probably initially shorted, respectively, which we didn't buy. So, and now what we've already seen is that obviously the strength in the US dollar, the credit definitely goes here to market participants now buying the US dollar in regard or based on their now clear outlook for the future and the rates they have, the outlook for rates they have in regards to the Fed. But still, I think it's close to a coin flip. Okay, it's nearly 50-50 that the Fed will nevertheless cut rates. And I think it's too much. I'm not saying that there's no real case for lowering rates into the end of the year, but therefore market conditions need to significantly change. For example, trade deal between the US and China falls apart. There's no trade deal. At the end of next week, we probably get one. We probably don't. I mean, we heard this several times now over months since December. And nearly every week they are very, very close. They are very, very close. And now we are in May and we still do not have a deal. And probably we get one at the end of next week. We still do not know. If this deal is struck, it depends on how it is struck and if it really positively affects the US or not. But all in all, if things fall apart here, markets are getting really volatile, and volatility shoots up, and we get to see similar moves as we did over the last 3 months in 2018. Well, then, sure, the Fed has to probably act and cut rates. But nevertheless, given the current status quo, there is no need to cut rates. In fact, we could think about hiking rates and not cutting them. And with this in mind, I think there's still too much dovishness priced in. And now we come to today's non-farm payrolls. They are expected. I prepared something. This is a beautiful chart here from Bloomberg in this case. It's a screenshot giving you an idea of here a normal distribution given. What market participants expect, an analyst from Bloomberg. And what you get here is that we have a median estimate between 185 to 190,000. So this is the biggest amount here. Nevertheless, we can also see that we have some very positive and some more negative analysts. But given that structure here in this distribution, what I would say is the following. The market really or NFPs have to disappoint massively to really catch the market or market participants on the wrong foot again. And even if this happens, it does not necessarily mean that the US dollar won't take on any bullish momentum. But in fact, I have somehow, also probably based on the fact that ADP data last Wednesday came in better than expected. Okay, yes, there's a grain of salt due to the fact that ISM employment the same day came in, mixed or below expectation. But still, I think that the ADP is a very good indication, and chances are good that we get at least a reading somewhere in the region between 185 to 190, and everything which goes above that expectation, and every data set which is above average hourly earnings, it's at 0.3 expected month on month, comes in at 0.3, comes in at 0.4. Something like that is definitely something which could be the driver for market participants then moving aggressively back into the US dollar. So, and with this in mind, I think the outlook for the US dollar is very positive, especially if a data set comes up above expectations. We will definitely see if I'm this time right. Last week, I painted a similar picture, and the US dollar only saw short-term bullishness and then sold off into the weekly close, and over the next days sold off bit too much probably, but nevertheless, probably I'm wrong again on this call, but nevertheless, if I look at the current situation, I think the picture hasn't dramatically changed. It's still very positive for the US dollar, and I think very bearish for the euro. And let's just see if things play out that way. What we can definitely spot is that the market's already taking on momentum on the downside. And if we get to see a better than expected data set this week, definitely chances are very good that we'll push back below 111 here and probably close the week below that level. And then the projected target around 109, 109.50 comes into play over the next week. And this is potentially the target which we should aim for when we are positioned on the short side in the EURUSD. So, that said, let's have a look here at another very interesting market. It's in this case gold. And by the way, everything I present right now can be already found on the website from Admiral Markets, admiralmarkets.com. And there, just go over to analytics and there into technical analysis. So every Monday, Wednesday, and Friday, you have one piece, a technical piece here in combination with the fundamental outlook. And today, based on the technical outlook for gold, based on this head shoulder formation, which we also made a topic, by the way, in one educational article some days ago. It's also linked in here. So you can, if you click on it, let me just see what happens. Oh, no, that is not good. One second, please. Let me just go back and I'll open it in a new tab. One sec. So you can find out everything which I just presented to you in regards to a positive outlook for the NFP. So I myself, I'm very positive for the US dollar. I also, by the way, I can just tell you here, I'm short EURUSD for quite a while, nevertheless. So it took me some time till the trade finally broke the lows last week. I never got caught in any way on the wrong side. So in fact, I had to have patience in this case. My stop is at 113.30. So the stop was never triggered since the beginning of April. It was closed, nevertheless. I have to mention that it was something like 10 pips or so. And I really saw the trade already, falling apart, let's say. And then finally we drifted lower and then we broke below 111. Nevertheless, I was surprised again last week. But, and this is the good thing, I have time because it's a trade which has a positive carry to it, which means I'm currently shorting the euro, low yield currency, and I'm buying the US dollar, which has a positive carry to it when it comes to buying the US dollar against the euro in this case. So which means I'm also gaining swap on this position here. And sure, from this perspective alone, I hope that my view here is right. And but this is also something I'd like to mention. I'm not only aiming for 109 on the downside, but I'm aiming for 105. I think that the euro definitely has further room on the downside, and we have a serious chance to go as low as 105, probably even lower than that, because the outlook for the Eurozone in general is very, very critical. And at the end of the month, we also have the European election here. My personal take is, so far, it seems as if the interest is really low when it comes to Germany. And I mean, Germany is the biggest economy in Europe. So such an election should usually wake up everyone. European election should wake up everyone here in Germany, and no one is really taking it serious. I mean, they take it serious, sure, but nevertheless, they are not really interested in it, which is very interesting because this could point to a very low participation rate, which makes it likelier, in my opinion, that radical parties, especially from the right, probably have a chance to get a very, very positive result here that comes where it's true for populist parties from Germany, but also from France, but also from Italy, but also from Spain. And if they gain momentum here, this could also act as a bearish driver for the euro, this political instability resulting out of it. But let's come back to the gold price here. So which means if I'm that positive for the US dollar, I'm also naturally negative for gold in this case. And so far, this head shoulder formation is playing out, and today's NFP data set here, which could then result in US dollar strength, as I already presented it, could naturally result in a gold pushing lower again, and there the line in the sand, I think, is 1,266. If we break below that level, further losses are very likely, and the projected target from this formation, and therefore you can do the following. You can, oh no, let me just do the following. I'm not using this chart, but I use the article which was already published, by the way, nearly 2 weeks ago, 1.5 weeks ago. This is the theory behind it, and there is the application of the head shoulder formation in gold. And now this is the beautiful thing about it. Have a look here at this chart. You can see that we painted this picture already 1.5 weeks ago. So you could have, based on these thoughts in this article, taken this pullback against 1,290 around as a potential entry for short engagements with a stop at 1,310. And as you can see here, what I do is I project here a line from the head of the formation down to the neckline, and then you duplicate it here, and then you get here out at 1,235. So for further information on this formation, feel free to check out the, in this case, traders block section. Then it's not the technical analysis, but it's the traders block, which is also here below analytics, but a little lower here. There you can find traders block. Just click on it, and yeah, if you have any questions, feel free to shoot them over to Admiral or to my end, and I'm more than happy to answer them. So yeah, that's it on gold. So the outlook for gold, in case of a positive reading for the NFPs, is very the positive outlook is positive reading in regards to the NFPs is potentially negative for gold. What's also of interest is surely, and this question will quickly arise, the question is, well, what is in case of bad NFP data? Again, based on this distribution, we can already see that many analysts seem to expect readings as low as 160. So we have some room between 160 to 190. Everything below 160 is probably then taken negatively. But even if the numbers come out worse than expected, that does not necessarily mean that the US dollar will sell off, because there's a second chance. The second chance is the average hourly earnings. If they come in better than expected, again, expected at 0.3, if they come out at 0.3 or 0.4, even a disappointment in the non-farm payrolls can still consider US dollar bullish once the average hourly earnings come out better than expected, and drive higher inflation expectations from market participants, which will naturally result in market participants expecting from the Fed not to cut rates anytime soon. Not only after the comments from Fed Chairman Powell on Wednesday, but also now finding another driver in the speculation after non-farm payrolls come out today. So yeah, that's it on EURUSD. This is it on gold. Let's have a look now at the DAX, which is also, well, very strong. I have to say I was really surprised to see the price action. Nevertheless, it could quickly change. So and therefore probably let's switch over then here to the S&P. And there we have the hourly. Let's just switch over here to the daily chart. Let me just take this out. This is, by the way, preparation. You might wonder, well, what is this? It's a preparation for an article which is published next week in regards to how to trade the Fed announcement drift, I've called it. Definitely worth reading. I highly recommend it. So stay tuned. Next week, it should be on Tuesday or on Wednesday. You will also find it then in the traders block section, similar to the head and shoulder formation in gold, but then on a well, probably we can call it a seasonality. We can call it a seasonality here in the markets. It's a very, very interesting idea. And by the way, there's also an academic paper to it, attached to it, which underlines the strategy given here. But now let's look here at the markets first, and then how what to make out of this current situation. So it was very interesting to see that the markets reacted in a bearish way on the comments from Jay Powell last Wednesday, which is, in my opinion, showing that markets, or the rally especially here from the December lows up to new all-time highs. And finally, we made it this week then here, new all-time highs in the S&P, but also true for the NASDAQ, for example, that it was mainly driven by expectation that the Fed will be very, very dovish over the months to come. Rate cuts will be likely. And now Jay Powell stating something which is showing that this is not necessarily given, and that markets should not expect the Fed to cut rates anytime soon. And there was a bearish reaction to that. Nevertheless, what was really interesting was that the DAX really shook it off. So on Wednesday, we had a bank holiday in Germany, the 1st of April. 1st of May was Labor Day. The DAX sold off quite sharp, or not sold off, but this is wrong. And we opened sharply lower. Let's put it that way here. And then yesterday we closed this. In this case, it was an untrue gap. Still, we closed it. We pushed to new yearly highs, and we tagged these levels again today. Even though yesterday numbers from the U.S., or especially not numbers, but the price action from the U.S. equity markets was lower, the DAX could still stabilize above 12,300 points. We found ourselves in a very choppy environment still. So this is definitely something we should take in mind. And then we took another stance now to attack 12,400 points. And this is still a level which is of interest for today. So we are closely watching this level. And now something interesting is happening. After yesterday, US equity markets didn't take on serious momentum on the downside. Somehow it seems there's still there's still a chance that probably there will be a significant push lower. Nevertheless, I was wondering, I think most interesting will be what will happen to FX markets, what will happen to especially gold, so precious metals, when it comes to the NFP reading. But still, I was wondering if my expectation of a stronger than expected NFP reading materializes, what will this mean to equity markets? And in my opinion, chances are somehow good that it could be taken as positive. And with this in mind, I'm not only seeing the US dollar gaining, for example, against the euro, but then also the DAX gaining here and the potential breakout on the upside. So that will be really, really interesting to watch, especially if this is a sustainable break. Nevertheless, this is only a very short-term idea. I have to say that from a risk-reward perspective, long engagements in DAX should be taken very, very carefully and considered carefully. The reason for that is there's a very strong resistance here on the upside around 12,450 points, probably a little higher, 12,500. It's a strong resistance zone resulting out of the September-October highs of 2018. And from there, we then took this bad beat, let's call it, and went significantly lower with the U.S. equity markets, high volatility rising from a very restrictive Fed, rate hike expectations, balance sheet runoff on autopilot, and all this. Still, it's a level which should be considered carefully, and where breakouts against could be of interest, at least for today, if the NFPs come in better than expected. Only problem we have is it's a thin market environment, so working with breakout orders here on the upside after this consolidation now taking place over nearly 3 hours, this is definitely something to be really careful about. So watch closely the data, how it comes out. And then we have to somehow hope a little, let's say, that the data which comes out does not push us aggressively above the highs here. But probably the market is holding, this is a 50-minute chart now, is holding slightly below that. And then we could work with the buy stop here in this area with a stop below around 12,370 points. So we have a risk of something like 30 to 35 points, and then respectively target for 12,500 points probably into the weekly close if data comes really out better than expected. What's also interesting in this regard, Shirley, is the fact that the euro against the US dollar here, if such a strong data set comes out, and if the euro against the US dollar goes down towards 111 again, that we also have to take into account that the weak euro is usually positive for the German economy, and that's sad, to some extent also positive for equity markets, at least short term. So currently this positive correlation is not necessarily given, but the thing is that there's at least a potential catalyst, further driver for gains on the upside in the DAX, which should be carefully watched, and which could probably drive us then at least up to 12,500 for the DAX in the days to come. Then the question is, okay, this is for today, what to expect for the upcoming week? Difficult to say, to be honest. Uncertainty around the trade deal between the US and China. A Fed which is at least to be considered neutral. So probably the U.S. equity markets are losing some of its steam on the upside. I'd say probably it's better to be careful when it comes to, or more conservative when it comes to long engagements in the DAX. And probably we're finding strong resistance here on the upside and a pullback. But nevertheless, the thing is that such a pullback is short-term bearish, sure, and probably we get some intraday short trends to see, but nevertheless, everything taking place here above 12,000 points, this region, or I'm sorry, no, it's not 12,000 points. 12,000 points is here. This is a potential long trigger, in fact. So if we pull back, 12,000 is a very interesting region for long engagements. Everything taking place above 11,800, 830 can still be considered bullish. And even if we drop below that, probably the picture would switch to neutral. But as long as we trade above this blue line, which is the simple moving average 200, the picture should be considered bullish and positive for the months to come. In fact, still, I mean, we are entering a period now which is not very positive for equities. Also something to remember. You probably heard of this old saying, sell in May and go away. But there's also a continuation of that. But remember to come back in September. So with this in mind, I mean, there are some statistics showing that this is potentially true. Probably the overall performance will find a cap on the upside. Still, I'm not seeing in the current market environment equity markets, for example, selling off sharply, but would be really careful with anti-cyclical engagements, wait for clear signals. In case of a short-term trader, an hourly chart, you probably should wait for short engagements to be taken till we break below 12,200, 180, 200 points. Some might be more aggressive, consider a break below 12,250, a short signal, but however you take it, I mean, we're trading 150 points above that, but so, which means we are neutral in this range we're currently in. Short-term breakouts on the upside can be expected, depending on NFPs today. Still, the question is, are these breaks sustainable? If they are not, we're probably pulling back into the range, but then we still have no bearish environment, but a neutral environment, only below 12,200. Things are getting interesting, and then we should wait if we can stabilize against 12,000 or push below that if it happens at all. Yeah, and so that's it from my end. I hope you enjoyed this webinar. I wish you happy trading. What's your stops? Be really careful today. Again, 1:30 p.m. London. There is non-farm payrolls being published. A very interesting data set. I just hope that I could give you an idea on how to how certain scenarios can play out. My personal take is that will be better than expected reading. It would be really great because it increases the chances that my current short position EURUSD continues to accelerate on the downside and probably go below 111 into the weekly close, which I would be really happy about, to be honest. And yeah, so that's it from my end then. I wish you happy trading. Watch your stops. Talk to you again next week on Friday at 12 p.m. London, and I really look forward to it. So all the best from here in Berlin, Germany. See you soon. Talk to you soon. Enjoy yourself, and bye-bye.